Happy Monday. Welcome to the Monday Market Update. I'm Nash Paradise, Director of Sales for UMortgage, joined as always by my dude, the man, the myth, the legend, Mr. Andrew Cady, out of sunny, freezing cold Florida. How are you doing this morning?
I am doing really good, man. What a wild week last week. This is probably going to be a little bit longer one than normal, but it's going to be a fun one today.
Yeah, last week was absolutely wild. One of the most volatile, crazy weeks that we've seen in years, honestly. Lots of good, lots of confusing, lots of, mixed bag. So we're going to go through the data here pretty quickly, get into commentary. We're going to talk a lot about what happened, why did it happen, what does this mean going forward, and does this change the way that we analyze econ data and what's actually important to the markets? It may. So let's jump right into our slides here and knock some of this stuff out, starting with what happened last week. Now, as far as econ data goes, last week should have been pretty neat, should have been pretty impressive. It was not. Do we have a slide for last week? Get through the volatility? Did we lose our director? No, we can just talk about it. So
we'll talk about it.
Last week, we're calling highly volatile. It doesn't, if you look at the results on paper, I think we started at 6.19% for the overnight average on 30-year fixed, got down to 6.06, but it did not get there smooth. We had wild swings throughout the week, especially Thursday, Friday, and it was all that good old Trump tweet on Thursday. I call it a tweet. It's Truth Social, but whatever. Tweet's a tweet. We'll get into what that meant and what that means going forward. But as far as the econ data goes from last week, you'd think a lot of this stuff would be a lot more impactful. So looking at, can you break down the jobs numbers a little bit? Because those were impressive. They did move the needle. We had some important revisions. What's your take on non-farm payrolls and the job stuff from last week?
Yeah. I think it kind of proves how short-sighted investors are, because the jobs report was overall a negative report, but there was one item in there that was a mixed bag of goods that kind of just tainted the entire thing. So expectations were 73,000 job creations. We came in at 50. So, pretty substantially low on the actual job creations. But there were also downward revisions. October's numbers were downward revised by 68,000. So we went from, I think it was negative 100 and some thousand to about a negative 160,000. So huge negative revision for October. And then into November was also revised down only by 8,000, but it was a negative revision. But investors kind of took the entire report as a mixed bag of goods, because the unemployment rate was also revised down for November's numbers. It was revised down from 4.6 to 4.5, and then December's numbers took it from 4.5 to 4.4. But it was really due to labor participation, not necessarily that we are back gaining jobs in the economy. So it just kind of proves that investors take headlines and not so much the data that drives the actual headlines.
Yeah, 100%. The stuff doesn't matter. Investors are worried about making money. So headlines move the needle. Do they actually care that we're at, 4.4%? No, it's what's the trend? What is it looking like? It looked like we were going up from 4.2 to 4.3, 4.4, up to 4.6. We had these incremental increases in the unemployment rate in the last few sets of data. And then all of a sudden, we've got a revision down from 4.6 to 4.5, and now new data at 4.4. So unemployment tracking mixed with the rate going down, but missing on payrolls. It's going to be interesting. We've got huge employment data coming up this week. So let's get into what's going on this week and whether or not it should matter. So Tuesday is the big day to circle. We've got ADP employment change. We also have the inflation numbers. Your thoughts on inflation? It looks like we're anticipating a slight uptick, 0.10% on the year-over-year core. Everything else fairly straightforward and pretty much the same. Do we have room to miss here like we did on the last set of employment inflation data?
I think we do. I think we have room to miss to the downside as much as we have to miss to the upside. I mean, obviously there's so many things in play with this. The thing that I think could be problematic in this for inflation is when you get into shelter costs, which is a huge makeup of the core inflation. Lodging away from home plays into that. And lodging away from home would be like your hotels, Airbnbs, that type of stuff. Well, what was December? One of the biggest travel months of the year of people traveling for Christmas vacation. I know where I live in like Airbnb heaven down in the panhandle of Florida. It felt like it was summertime here. I mean, went to Publix and you had to stand in line for 30 minutes to check out. So I think we could be in for a little bit of an upset in the lodging away from home category, because with heavy travel days would come issues of people price gouging and upping it.
100%. Getting into, breaking down the CPI further, we had a projection of 3.0 on that inflation prior, and we came in at 2.6. That was a heavy miss. And now it sets us up to, have this projection of 2.7, which, when you look at the last 90 days, that should still be down. It should still say inflation is coming down a good bit. But if we hit on the estimates here, it actually looks like it's going up. So I think that's going to be mixed. It could be, a good market mover if markets decide to care about data again, which as of last week, they did not. So kind of last thing we like to touch on, I've got the data in front of me for, the Fed. We got a meeting coming up on January 28th. Likelihood of a Fed cut then, it's basically zero. 95% we're staying still. And as I look through these numbers, just to kind of convey what I'm seeing here, the interesting thing is the likelihood of that Fed cut. We are talking as soon as, March or April, and April was looking more likely than not to cut. Now it's looking more likely that it's not, with a nice solid 92% cut by June. I kind of like the idea of this getting pushed back further, but there's so much information that's going to happen between now and then. It just means that we're still targeting 2 cuts this year. Are they going to be April and, September? Is it going to be June and October? No one knows for sure until we get closer, but I would call this a big old nothing burger, as things are just going to sit stable for a little while. Anything you'd add to that?
No, I tend to agree with you 100% on that. I do think it's very interesting that we've moved out, a month on that first rate cut. And I think that's really just indecision right now. I think investors look at a mixed bag of good reports. They see weakness in the labor market, but they also know that the Fed focuses so much on unemployment rate. And for that to come down from 4.6 to 4.4, I think it's put the market in the sense that, hey, Fed's not going to be moving too quick on this.
100%. All right. So let's get to the stuff that everyone wants to hear about, the news of the day, of the week, what we actually need to be able to regurgitate to our partners, to buyers, to the overall market, what everyone needs to know. How do you explain what happened Thursday night, Andrew? And for those of you who don't know, we got a Trump tweet about Fannie Mae and Freddie Mac, how fantastic they are and how lucky we are that they haven't been privatized, and, Trump taking credit for things that kind of had nothing to do with. But hey, throw a little hyperbole and exaggeration in there. It wouldn't be true social if it wasn't. But that they've got $200 billion of excess cash. And now it's not really cash. There's only like 30 billion of it that's cash, but a lot of it is, maturity dates coming up that's going to turn into short-term capital. And with a direction from Trump to move that capital into purchasing mortgage-backed securities. So for those of us who don't live in this world, Andrew, what does that even mean and what can that do?
Well, we saw what it did. We saw a wild, volatile week or day on Friday. I mean, we saw interest rates. Let's just say this. If the gains we saw Friday morning pre-market would have held, we would have seen a nice 5.6, 5.7 handle on interest rates. The gains quickly faded, but we still saw a massive drop. And I think the really interesting part of this that I think we have a lot of good coming out of is that the interest rates officially settled in at the low point going back a year plus 2022. I mean, so we're actually dipped below a lot of these kind of resistance levels. But to put it in a nutshell, mortgage-backed securities need to be purchased. They're a securitized. When we write a mortgage, the mortgage becomes securitized into a pool. Like, go watch The Big Short. They explain it very well in there. It securitizes into a pool, and then investors have to buy them. And high interest rates means there's not a lot of investors, or investors want a lot of yield. Why? Why do they want that? Well, they want it because they're looking at a scenario saying, hey, we've got a pool of 7.5% interest rate loans. We want a high premium on those because if rates come down at all, everybody's going to refinance. We're not going to collect a lot of interest on those loans. So buyers for mortgage-backed securities have been a challenge. They've demanded higher yields, which drives mortgage rates up, because they know as rates come down, it's going to refi rather than collecting interest for the average of 7 years. It's dropping to 3 years. There's a lot of change going on. Well, if Fannie Mae and Freddie Mac become the biggest investor of mortgage-backed securities, it alleviates a lot of the pressure of needing outside investors, at least for a short term. This isn't a long-term, continued trek down, but to me, this is a really strong shot in the arm to drop interest rates. And we've seen after the crazy volatile swings, a really solid 0.25% drop in rates. And that's seeming to hold as of this morning.
Yeah. So if I'm breaking down what you're saying here, this is temporary. It's not a long-term solution. This is, like I said, a shot in the arm. This is instantly impacting the mortgage-backed securities that have the most direct impact on mortgage rates. The foundation of where mortgage-backed security yields need to be in order for a balanced market, that still comes from the 10-year treasury yields. Those are the most similar. They definitely move in lockstep. And so what this has done, those two things have been moving along together for a while. And now when you look at the overlay chart, you've got mortgage-backed securities shooting up and giving us better interest rates while the 10-year treasury has held at this 418, 419 mark. It's actually on the high side of the resistance right now, which is concerning, which just means that this isn't going to hold real well. This is a narrowing of the spread between the 10-year treasury yield and the overnight average on the 30-year fixed. In fact, we're below 2% right now, and we have not been below 2% for a while. I don't want to say it's concerning because it's good news, but it is, it's impacting the thing that has the most, direct involvement, but it's not solving the underlying problem. What we really need are these yields to drop. We need some, abandoning stocks for bonds, and nothing seems to be moving the needle that direction right now, which is fine. The next best thing is impacting that yield spread directly. And hey, okay, well, the purchase of mortgage-backed securities, $200 billion sounds like a fortune, but when you consider it's a greater than $9 trillion market of MBS, it's good. But the funny thing is, that's just a tweet, and here we are getting 40, 50 basis points better. I always say
nothing's actually happened yet. This is just an idea that's being floated. Now the question becomes: is this a 50-year mortgage and portable mortgage idea? Is this just a tweet that goes out that ultimately becomes a past headline 3 weeks from now, or is that actually going to happen?
That's a great question, and I would counter that with, does it matter? Do the markets care? Markets move on anticipation and expectation, not in reaction to things that have happened.
Agreed.
So, everything gets priced in. We saw 3 Fed cuts to the rate and no movement in the 10-year treasury bond. That's because we knew they were coming. We see Trump tweet about this and instant impact, instant improvement, and about the same kind of improvement that we would expect with that kind of purchase, an extra $40 to $50 billion a month for 120 days. Yeah, that's going to hold some price stability on MBS yields. So whether it comes to fruition or not, I do believe it will, because it's something within the confines and controls of what we can do with the GSEs. I mean, that's why we have GSEs, Fannie and Freddie, is to have some control over affordability. Because of that, we've got this improvement. We've got these changes. Cool. Next huge topic here. What in the world do we make of this? Department of Justice, Trump administration going after the Fed, talking about indictments and investigations. What does that mean to us on our side in the mortgage market? And what's the likelihood of anything on this coming to fruition?
I don't want to get into politics, but I'll speak as directly as I can on my feelings on it. And I would love your thoughts on my feelings. Nash and I haven't hashed this out. I think if everything would have just been left alone, there's a high probability that Trump would have gotten the Fed chair he's looking for. And it might still happen. There might be, because the president installs the Fed chair. But there is a push going on right now at the Fed. A former Fed insider, current economist Danielle DiMartino Booth, has written an open letter to the FOMC committee asking them at their January 28th meeting to act upon the power that Congress has given them to install a temporary Fed chair for a term of 1 year. So this would push us into 2027. And she is actively calling for the Fed to basically stop in her words, the meddling of the president into the Fed. She wants the Fed to maintain its autonomy and to remain separate. And I think this probably wouldn't have gotten a lot of traction, but the harder it's pushed with DOJ investigations and these type of things, it would not surprise me if we see the Fed come out at the end of their 28th meeting and have a new Fed president put in place that carries us all the way into 2027. And if going back to expectations, if the markets are expecting a Trump appointee that is going to fight for lower interest rates, and that happens January 28th, we could see an absolute upending of our markets. What's your thoughts on that, Nash?
I completely agree. Going back to the first couple of points that you made, there's been a lot of pressure from the administration towards the Fed. Without getting, I don't mind getting into politics, but it doesn't, that pressure isn't necessarily, I don't know where it's coming from, because the Fed, lowering rates a whole lot quicker isn't going to instantly change affordability. Like, these are macroeconomic changes that happen over long periods of time. And, I'm almost confused as to why there's so much blame. Like, everything else goes into the same pot. It all moves the same way. If the Fed just gets hyper aggressive and drops another 50 basis points off, if there isn't economic data to support that, money is not necessarily going to follow the Fed. Regardless, I do agree that pushing as hard as they have, we've seen Powell in his press conferences, kind of bow up and dig in his heels a little bit. Got a little chip on his shoulder. Dude's been doing this a long time and is pretty confident in his role and knows the autonomy that he has. So, to think that the Fed could go and appoint their own chair at their next meeting, it's absolutely up there on, could happen. And like you said, if that does happen, and right now we're anticipating a Trump appointee, that could be really, really bad for interest rates. We could see much larger spreads as, investors want more yield for their money because uncertainty, volatility and uncertainty are never really good when it comes to mortgage lending. That just means bigger spreads for the big money. We need to have a good idea of what's coming and what to expect. Do you go anywhere with the investigate? I think that's all very unlikely given the Fed's autonomy. But, it's not a good look when you're spending $2.5 billion on a building renovation. That's going to put a target on your back. And that's a really good distraction if you're trying to find something to focus on that's negative about what the Fed's doing.
Yeah. And then, another topic from last week is another tweet by Trump about cutting or capping interest rates on credit cards at 10%. And again, this doesn't necessarily impact our markets, but it impacts markets. I would love to kind of hear your thoughts on what that looks like, because I have some really kind of in-depth thoughts on it that I think is really bad idea.
Yeah. My initial reaction was, oh, hey, a little extra, like you turn credit card debt cheaper, you reduce the minimum required payments, you're going to instantly get money moving into the market, which is not necessarily going to be great for inflation, but you're going to get instant spending. But that's how our economy works. The people who are living paycheck to paycheck, who are relying on credit cards, those are the people where, when you give extra money out there, it's going to get spent, it's going to get recycled. That leads to, inflation in a short and, medium term. But then I started thinking about it more, reading some commentary from other people, and realized that like you can't break the bank. You're not going to have the kind of impact you want. You do something like cap credit card interest rates, all you're going to do is see everyone's available balances tank. You're going to see credit scores plummet, where that $25,000 line of credit that you owed $8,000 on now is a $9,000 line of credit. Like, banks are going to respond in kind. If you don't have 800 plus credit, you are not a good investment for non-secured financing at 10%.
Bingo.
So yeah, I liked the idea when I thought that everyone could, just make life cheaper, and then realized that in practice, banks are going to bank. And if that's not a good investment for their capital, they're going to rip. I mean, it's going to get real bad before it gets better. People are going to have, some difficult decisions to make. Things are going to go and get charged off, which is going to make money even more expensive for lending. It's pretty much bad all around after sounding like a neat idea.
Yeah, and listen, guys, it's midterm election year. There's going to be a lot of neat ideas, like portable mortgages, like all this stuff is neat ideas. 50-year mortgage on a face value sounds cool. Capping interest rates on credit card at 10%. I had the same reaction. I saw it, and I'm like, that is so cool. Like, so many people are going to be benefited by this. But you're dead right, Nash. Like, credit lines are going to be cut immediately. And the immediate impact on that is a tanking of credit scores. Why? Because of credit utilization. So let's say I've got a credit card with a $10,000 limit, and I've got $1,000 on that credit card right now. I've got a 10% utilization. That's helping my credit score. If I had like a 605 credit score and they had given me that because I had a long history with them, now they see me as high risk. They cut my credit line to $1,000. Now I have 100% utilization. My credit score would tank by 50 to 70 points like that. It's going to massively impact consumers on that front, but it's also going to massively impact consumers because you're dead right. Like, banks are going to bank. They're going to cut the credit lines, the high risk ones first. There's a lot of consumers that are buying groceries on their credit cards right now. Should they be? No. But is that what they're being forced to do? Yes. Look at the credit card debt. People are in really tough spots right now, and credit card debt is at an all-time high for a reason. And I don't believe it's buying TVs in most cases. I think people are putting their groceries on it. And all of a sudden, you're going to have a whole section of the American consumers that lose access to their credit cards because the credit lines are cut, or the cards are just simply closed down. They're just too high of a risk to take it on anymore. I think on face value, it's a beautiful idea. On the long-term effects, I think you're going to lose a lot of baby with the bathwater on this one. You're going to end up having a lot of negative that comes out of what seems to be a good idea.
Yeah. And the fact that it was pitched as a 1-year temporary thing, that may help it not be so crazy impactful, because banks are usually looking longer term on their stuff. Maybe this is the art of the deal, where you throw out a wild number like 10%, and then you talk to some banking execs, you get with people who are big time decision makers, and you settle on something like 14 or 15%. Who knows where this is really going, or if it's something that that Trump even has the power and authority to do. I'm not 100% sure he does. The government's funny on what can you, what can't you do. Well, you just do something, and you wait for it to get challenged in court, and then the court determines whether or not that's legal, and everyone's got an opinion on it up front, which is kind of funny. The other thing that is easy to forget about is what happens without access, or what happens when your credit score drops. When you go from a 690 to a 620, from a 740 to a 680, and those are the kind of drops that we'll have if this credit is, if your utilization changes. Life gets more expensive. You start looking at things like non-secured loans through, we see them all the time on credit reports, like, debt consolidation things, some of these really high, Affirm and SoFi loans that are, being used a lot right now by consumers. Those are there. But then your cost of everything goes up. You need to buy a new car. You have lower credit. That payment's up by $100, $150 a month. Auto insurance, homeowners insurance. There are a lot of different things that look at your credit scores. So losing points for no good reason other than your limits have shrank to match your, current utilization, that makes life more expensive for the people that cannot afford to have their life more expensive. People that are high earners, high net wealth, high 800 credit scores, like, it's not going to make a difference. I pay my credit cards off on a monthly basis. So interest rates are irrelevant. They're not going to mess, but like, I'm that person that the bank says, okay, 10%. Yeah, we'll still keep his credit lines open, but I'm not really paying interest on that credit anyway. So the people that can afford to pay the interest are the people that are going to be getting the help. And everyone else, yeah, they're kind of going to be SOL on that, in my opinion.
Yeah, it's gonna be an interesting next 4 or 5 months as we head into the midterms. There's gonna be a lot of catchy, really cool sounding things that have really long-term consequences. And Nash and I are gonna be here to break it down for you. That's our goal and job.
Yeah, every week we're going to be coming back. Next week will be interesting. We'll find out, does the market finally care about data? Because we're going to get a lot of it on Tuesday. Are we going to get more tweets that move things around? Are we going to have some more pressing on these margins? Are we going to get another random bit of data that throws everything into whack? We'll have to come back next week and see, because right now, just hold on to your horses. If you like it, lock it. Take the win for what it is right now. Definitely on the lock alert, not floating anything in this crazy market. Any other final thoughts that you'd add?
I think we covered it all today. Have a good day, guys.
Love it, man. Take care.